A is number 23. Accounting for investments in associates. The two, the company requires to prepare consolidated financial statements. Is that okay? If company A invested more than 50% shares in B company, okay, then automatically A is named as holding company, B will be named as subsidiary company. So what happens here? A has to prepare separate financial statement for A, as well as B has to prepare separately their own financial statement. Apart from that, you have to prepare CFS, consolidated financial statement. Consolidated financial statements. If A, okay, investors around less than 50%. So if it is less than 50%, A limited has no controlling rights on B. No controlling rights on the B. Then how can we treat this? So here we no need to prepare the consolidated financial statement. For A, you have to prepare separate financial statement, and the investment made in B will be named as investment. Okay, separate financial statement where the amount invested in B included in the investments asset side are named as investment as per AS number 13 provision. So I'll finish off AS number 23, then directly go for 27, then we'll jump to AS 23. It's 13. All the four components will be similar. Okay. If I hold more than 50%, then I have the holding company status, the other company is subsidiary company. Then we can simply merge these two and prepare a single consolidated financial statement. If the investment is less than 50%, then that will be named as investment only. Now, if the investment is anywhere between 20% to 50%, A has made an investment in B anywhere between 20% to 50%. Then B is named as associated company or associates. Right, associates. Meanwhile, A has invested in C more than 50%. For C, A being holding company, C being subsidiary company of A, and B being associate for A. Now, A has to prepare what? Consolidated financial statement. This consolidated financial statement is nothing but the balance sheet of A as well as the balance sheet of C. To the extent held by A is merged, the extent held by outsider is named as minority interest in the CFS. That's how it is shown. Clear? Now, what about the investment made in associates, sir? If the investment made in associates, where A requires CFS preparation, this investment will be prepared under equity method, shown under equity method. Is that okay? Under equity method resembles like AS number 21 to the extent of holding in B company. Only to the extent of holding in B company is going to be incorporated here in A's book. In case of consolidation, you consolidate all the assets to the extent of holding by the holding company and subsidiary company mutually cancel. Right. So ultimate value being either goodwill or capital reserve. And the extent held by outsider is named as minority interest. In case if A company holds more than 20 or less than 50, of course there is no holding company status, then we can call this being the associates. Investments in associates. If you are supposed to prepare CFS as per AS number 21 because of being the holding company status of some company, the associate company's investment should also be valued under equity method and incorporated with the CFS account, where the shares held by the outsider is not a matter. So in this case, what happens, A will add A's assets and liabilities and C's assets and liabilities, where minority interest will also be shown in the CFS, and B's equity value will be shown. Equity is nothing but net worth like. The shares held by outsider, probably it is 25%. In B, another 75% held by others. We never bother about that one. But in case here, A invested 60 percentage. 60 percentage mutually cancelled. The equity shares as investments cancelled to the extent 40 held by outsider is named as minority interest. But under B, to the extent held by A, 25% net worth will be shown here at the purchase cost. At the purchase cost, and you do plus or minus with respect to any subsequent profit and loss realized. Okay, clear? That's the logic. So, company A has more than 50% share in B. Okay, more than 50 percentage. From this, it is very clear. A being holding company, B being subsidiary company. A invested in C 30 percentage. Then here C is named as associate. And A has invested in D 15 percentage. 15 percentage. Then it will be called as investment. This is called investment. In your balance sheet, how will you show? In case of share capital, reserves and surplus, non-current liabilities and current liabilities, and non-current assets and current assets. Is that okay? So, H company's assets and liabilities will be taken as it is. No problem here. H company's value will be taken as it is. S company's holding, is that okay? Will be set off with the equity share capital of S company, and investment will also be set off here. Okay. Equity share capital of S company, resource and surplus of S company pre-acquisition. Okay. And investment in S company. All these things are cancelled. To the extent held by outsider will be now appearing as a new item, which is called minority interest. Will be appearing as minority interest. This is how we usually incorporate the subsidiaries assets and liabilities in the holding company's assets and liabilities under a CFS method as per AS number 21. Now, what happens in case of C, sir? In case of C, you have to show the investment. You have to show the investment in C at cost. At cost. At the time of acquisition, at cost. Always the cost price is compared with the net worth. Because of comparison, you may get either goodwill or capital reserve. Either you get goodwill or capital reserve. Or capital reserve will get. So the amount invested, the 30% invested in C at a price of rupees 3 lakhs, but net worth, the share capital's value and pre-acquisition profit, all these things put together. Net worth you calculate, no. In case of cost of control, in the same way you can adapt. The value being 2,70,000 rupees. So you paid 30,000 rupees excess, that 30,000 will be named as goodwill. Will be named as goodwill. Is that okay? And investment continues to appear at its own original value rupees 3 lakhs. Clear? Hope now you'll be able to understand it. This will be as per which section, which accounting standard? A is number 23. What about the D, sir? In case of D, you have to adapt A is number 30. How to show the investment in any company where the investment worth being less than 20% case. It's only investment. The cost will be taken. Okay, depending upon the investment's nature, whether it's a short term or long term. In case of short term, always it is adjusted to the current market price. Market price or cost, whichever is lower, will be taken. In case of long term, unless the loss being permanent, we will not adjust and we continue to appear at its own original cost price. Okay. We'll study AS number 13 in detail along with the accounting standards number 13. Is that okay? By adding all these things, that's how you can present. To the extent if you are holding more than 50%, that will be just similar to the consolidated financial statement as per AS number 21. While preparing CFS only. If you hold in another company in the range between 20 to 50, then it also be included here under equity method. Apart from that, any investment made in any of the companies where the value is less than 20% of holding, just investment as per AS number 30. Okay, you have to follow those rules and regulations for preparing your financial statements. So the main objectives of this AS number 23. Accounting for investments. Accounting for investments. Investment means more than 50 holding company, that comes under AS number 21. Less than 50 but more than 20. Also investment provided in associate, that will be associate. If we are investing anywhere between 20 to 50, it's an associate. But that holding company requires to prepare consolidated financial statements. Only when they are required to prepare consolidated financial statements, then associates financial statement will be, means associates investment will be shown under equity method in the consolidated financial statement. Lay down. So what are the main objectives? Lay down the principles, procedures for recognizing investments in associates. How can we recognize that? And its effect. For CFS, reference to AS number 23 is compulsory. You have to follow AS number 23. For the companies following AS number 21. If the company follows AS number 21, then they have to follow AS number 23. If the company requires no AS 21, then no need to follow AS number 23. That they consider that being only investment. Though it is being the associate, they will consider this being investment. For standalone financial statement, AS number 13 will be calculated. Standalone is nothing but separate. Okay. Holding company, subsidiary company, and associates. So what happens here? What happens here? Holding company has to prepare CFS as well as standalone or separate financial statement. For separate financial statement, the investment made in S and A both are investment only. Investment only. While preparing CFS, they have to include S balance sheets incorporated with H balance sheet. Apart from that, A's investment should also be included here under equity method. Under equity method. Is that clear? Suppose A company has 40% in B company. What about this, sir? This is purely investment where you have to follow AS number 13 only. AS number 23 will not come here. Why? A is not required to prepare CFS. A is required to prepare CFS only when the company being the parent of any other company, means holding more than 50% shares in the other company. If it is not so, CFS is not there. If CFS is not there, automatically AS number 23 also not required. Associate, in which the investor has significant influence, but not subsidiary and joint venture. Okay, subsidiary and joint venture. It should not be subsidiary or joint venture. Clear? Significant influence. Significant influence. Okay. Whatever the management decision is there, this holding company, the company can influence the decisions. Then this is called significant influence. To better understand, anywhere between 20 to 50. It's not necessary, it should be 20 to 50. Even the company may have only 15%, but they will have the power to represent in the voting, decision making, criteria formation. For all these things, they can dominate. Then significant influence is there. But for simplicity, we will have the number 20 to 50. 20 to 50. Even I have 30%, still I don't have any power to influence. There may be chances. Okay, I have 30% in any another balance 10 dispersed among all the individual investors, 2 shares, 5 shares. Like the company has almost 10,000 investors, where my investment is 30%, another person's investment is 60%. Can I say that I have a significant influence? No. Whatever the 60% holder says, it will be implemented. I can do no justice for my investments, right? So significant influence is nothing but the power to participate in financial and operating policy decisions of the investee, but not control. I can just represent, influence, but I cannot dominate. If I say that Mr. A should be appointed as a director, no one can object. Then it's called control. Okay, sir, that will also be taken care. If it is possible, we will appoint. Then it is called significant influence. Hope you will be now able to understand the difference between control and significant influence. Clear? Now, significant influence. Especially significant influence is with respect to the economic decision making. Economic decision making. whatever the economic decisions taken by the company, in that I am able to influence. Economic decision means the director appointment influences the performance of the company, and salary also there. Based on that, revenue may also be impacted. So as the revenue gets impacted, my 30% or 20% share may be affected. So if I am able to influence in the economic decisions, then I may be considered as having significant influence in the company. Okay, having some voting power based. Shareholding is anywhere between 20 to 50. Okay, 20 to 50. As I already told you, though I hold 20 to 50, still not an associate. Why? If I don't have the significant influences demonstrated. Though I say I hold a 30 percentage, can I say that I am being holding significant influence in that company? As just now explained, the competitor holds 70% shares, where he himself has the majority, can control me. Okay, so I cannot influence that at all. So that's the first case. Shareholding is less than 20 percentage, still associate if significant. Even though I have 15%, still I am able to control the other company, then it is called significant influence. If nothing stated, very simple, 20 to 50 will be considered a significant influence, but not necessarily. Read the questions carefully whether the holding really signifies this term correctly or not. Okay. And second one is all about a representation on the board of directors. Okay, a company can represent. Represent means he can represent his own related persons to be appointed as a director in B company. Okay, not necessarily holding more than 20%. Anywhere between even 15-20 is also okay. A can dominate B's board of directors to appoint one of his own represented persons. And participation in policy making. Any policy made by B also be consulted in consultancy with A only can be passed, then automatically A has significant influences. And material transactions. Okay, so A is a predominant supplier for the raw material required by B. If A doesn't supply, then B will be in trouble. So automatically A can control the other company because of this raw material or some other technical know-how. These are the things also be there. So technical information or material transactions like sharing technical knowledge and sale of goods and services and interchange of managerial personnel. So A's top official will become the directors of B and vice versa. In those cases, A has significant influence in B. So for a rough understanding, anywhere between 20 to 50 will be considered as significant influence, not necessary. If I am holding significant influence in another company, do I want to follow AS number 23? That if I ask that question, immediately verify whether I need to prepare CFS as per AS number 21. Yes, then automatically AS 23 also be applicable. Clear? Now, control exists. What is called control? AS number 21. A is number 21. A controls B. How? A holds more than 50% share. Then automatically A has the controlling power over B, and A is holding company, B is subsidiary company. Or A and B. B has board of directors numbers B 7. Out of that, A appoints 4 directors. So more than 50% directors of B is appointed by A. Then also A being the holding company, B being the subsidiary company. And A holds more than 50% in B. B holds in C more than 50%. What happens then? B is the subsidiary company and A is a holding company. Between B and C, B becomes holding company, C becomes subsidiary company. Is that okay? And between A and C, A is the holding company, C is the subsidiary of subsidiary or simply subsidiary company. Is that okay? This is direct subsidiary. This is the subsidiary of subsidiary indirectly controlling the other company. Okay. Hope now you will be able to understand. So ownership directly or indirectly through subsidiaries of more than one half of the voting power. Number 1. So this is nothing but this point. Number 2, or control of the composition of the board of directors in case of company or of the composition of the corresponding governing body. Okay. In case of any other enterprises, so as to obtain economic benefits from the subsidiary companies, right? So if it is not being company, sir, what happens? Some other enterprise, probably partnership firm or some other fund, if not being the company, what happens then? There is no directorship, sir. Then, if in the absence of directorship, who is the chief controlling officer for that? If the chief controlling officer is represented by the holding company, that is also considered as control only. In case of partnership firm, we don't have the percentage of shareholding, right? In that case, automatically controlling power will be decided based on the policy making ability. Provided economic benefit should be influenced. Economic benefit should be influenced. Is that okay? See, gratuity trust is there. Gratuity trust. Gratuity trust. Clear. The board of directors of gratuity trust being A, B, and C. Three persons are there in board of directors of gratuity trust. Clear? Now, A, B, and C. Now, ABC and Co. or ABC Limited Company has the power to appoint these two persons. These two persons. C is appointed by some other companies or voluntarily, whatever it may be. What is the meaning of gratuity trust? For employees' retirement benefit, as per the salaries you might have studied, employer might have contributed for the employees' retirement benefit. Sometimes after retirement, there may be lump sum compensation may be offered to the employees for their retirement life, right? For that sudden payment from the employer's liquid cash may be trouble, so they start depositing slowly some amount in the gratuity fund. When the need arises, immediately gratuity fund will release the gratuity to the employees as per their requirement. Is that okay? Now, the gratuity trust is an entity. This entity has three directors to administrate. Out of the three, two are controlled by ABC Limited. Now, can I say this is being the holding company, this is being subsidiary company? If I ask this question, definitely not so. Because what is the intention of gratuity trust? To make any profit? I don't have the intention to make the profit. It's only for the employees' settlement at the time of retirement safely. So I don't have any economical benefit because of holding this one. Then it is not considered as AS number 23. It is not considered as associate or subsidiary company, not required to be consolidated. If any company is controlling the composition of governing body of gratuity trust, provident fund trustee, etc. Okay, is not considered, since the objective is not economic benefit, and therefore it will not be included in CFS. That will not be included in CFS. Hope now you will be able to understand this one. Clear? Now let's move on to the next one. Conditions for enterprise is considered to control. One is appointment. Another one is a person's appointment, okay, appointment to a position. And 3, director member is nominated. Clear? So all these 3 will be falling under control only. Okay, control only. Clear? Appointment to a position because of other appointment. Okay. See, XYZ entity, ABC is a company. ABC appoints the director for XYZ. A represents somebody else to be included in the board of directors of XYZ. Okay, board of directors. So ABC represents Mr. A, and A becomes one of the board of directors. Automatically ABC controls XYZ, appointed by ABC. It may not be board of directors, any management committee. Okay, if there is no board of directors, then many management committee will be there. No, in that management committee, who are the person managing is appointed by ABC. Another one is Mr. A becomes the director of XYZ. Director of XYZ. Is that okay? Whoever it may be, if he is being the director, automatically Mr. A also be one of the director of ABC. There are n number of entities possible. XYZ, then IJK. Okay. So here B. Whoever it may be, ABC no, for the board of ABC's board of directors, will be the board of directors of these all the companies put together. You might have heard about the term syndicates in especially university syndicates. We have lots of syndicates. You just think of syndicate, university syndicate. Some process may be called as we are the members of syndicate, syndicate member. Have you heard about the term syndicate member? It's a governing board like for universities, syndicate member. All the college professors will be, means the principals will be the syndicate members, default. So if you are getting appointed as a principal, automatically you are chosen as a syndicate member, nominated automatically. So a person's appointment as a principal follows necessarily from his appointment to a position or a person's appointment as a director. Where? Syndicate. To get yourself appointed as a syndicate, necessarily from his appointment to a position means principal. If he is being appointed as a principal, automatically it becomes member of the syndicate. Right. Now there is an economic committee also in India. Lots of economic forums there. So whoever FM may be, finance minister becomes a automatically chair for him. Okay. So what happens in case of CA Institute? To whom we have to address? CMA Institute, CS Institute. So all these things are coming under ministry, right? Ministry of Economical Affairs. So who is the chairman for economic affairs? Whoever the FM may be becomes chairman. So it is not appointed as a chairman specifically. Once he or she got elected as what? Minister for economics, finance, automatically becomes the chairman for this. That's what about the appointment here. A person's appointment as a director for something, necessarily from the appointment of another position. If you are getting promoted as a principal, you become the syndicate member. Clear? Next one is nominated. Okay. So you yourself nominate. And nomination will also be considered as directors. Okay. I mean, control. So GST Council, directors. Okay. Directors and members. And who appoint? We'll just check. Union Minister of State in charge of Revenue of Finance. Okay. Union Minister of State and Minister in charge of Finance or Taxation. So by default, if you are elected as a Union Minister of State, you become one of the member. Union Finance Minister will be the chairperson. So it's not appointment. Once Union Finance Minister, like if you are elected and appointed, automatically you will be GST Council's chairman. Clear? Hope now you will be able to understand this logic. So due to these reasons, you can control the other entity. Okay. Now come on, tell me. A Limited has 70% holding in C Limited and B Limited also has 28% holding in the same company. A, C, 70%. B holds 28%. So between these two, what happens? A being holding company, C being subsidiary company. Between C and B, C is the associate for B. Associate for B. A has to prepare CFS. What about the B, sir? Do I want to prepare CFS? No, not clearly stated. If B being the parent of any other companies, then CFS is required as per AS number 21. So now what happens? What about AS number 23? Will the AS number 23 applicable or not here? Okay, to check whether AS number 23 is applicable, AS number 23 applicable, So two questions are there. What are they? Okay. AS number 21 is mandatory. Then AS number 23 is applicable. No, sir. AS number 21 is not mandatory, not applicable. Then AS 23 is also not chosen. Clear? Clear? So A being the parent company and C being the subsidiary company. A Limited is holding 90% share in B. 90%. And 10% shares in C. 10%. And C. And B is holding 11% in C. Now come on, tell me. A is the parent company. B, where the holding is more than 50%, so subsidiary company. What about C? How much held by A? How much held by A? 10% directly, routed through B another 11, collectively 21%, then automatically C will be subsidiary. It means associate. Associate. Is that okay? But while accounting, while consolidating, you have to consolidate this way: 10% direct holding. Out of that 11%, A holds only 10, 90, another 10 held by minority. That's why 90% of 11 will be taken. Yes, come on. What is the holding in C? Holding in C by A? 19.9. So as the 19.9 is less than 20%, don't argue that it's not associate. For verification whether it's an associate or not, directly add these two numbers. For the consolidation purpose, you have to consider only 19.9% because another 10% and 11% is held by the outsiders, maybe minority interests, right? Okay, A Limited with B Limited holding 10 plus 11%, that is 21%. Hence, C Limited is an associate of A Limited. Anyhow, for the CFS purpose, the holding is only 19.9% alone. For the verification of associate or not, you have to absolutely add these two. For the consolidation purpose, to the extent of their assets going to be included here, you have to consider that holding 10% plus 90% of the holding the shares by subsidiary company in the sub-subsidiary companies, in sub-subsidiary company or associate. Is that okay? Hope now we'll be able to understand this one. Now let's move on to the next one. Online students, is it audible? Are you able to see the screen? Come on, text me. Hope it is clear, right? If it is clear, text me so that we'll move on to the next content. Now, A Limited acquired 45% of B Limited share in April 1, 2023. The price paid was 15 lakhs. Following are the extracts of the balance sheet of B Limited as on the date of acquisition. This is the balance sheet. B Limited has reported net profits 3 lakhs and paid dividends 1 lakh for the year ended. Now, this is as on the date of acquisition. Let's first verify, find out what is the value you are going to show as your cost of acquisition in your books. Cost of acquisition in your books. So on the date of acquisition 1/4/2023, 1/4/2023, is that okay? So I'm going to follow equity method. I'm going to follow equity method. Cost of acquisition being R, which is the investment, cost of acquisition of investment. What rate we paid for purchasing this? 15 lakhs. 15 lakhs minus net worth. How much is that? Equity share capital 10 lakhs, out of that 45% being 4.5 lakhs. Securities premium 1 lakh, 45% being 0.45 lakhs. Reserves and surplus 45% on 5 lakhs, 2.25 lakhs. Overall total being 7.2 lakhs. The net worth being 7 lakhs 20, but we paid 15 lakhs. We paid 15 lakhs. The excess payment being 7 lakhs 80,000. What is this? Goodwill. The calculation seems to be similar to AS number 21. But year on year, this investment value will be adjusted. Investment value will be adjusted. See here. This is at the time of consolidation. Investment value will be adjusted. So investment value being 15 lakhs by the first year end, 31st March 24. V Limited has reported the net profits rupees 3 lakhs and paid dividend 1 lakh for the year ended. Okay. Has reported net profit. Okay. So net profit 2 lakhs add. In that net profit, holding company share, A's share being 45%. How much is that? 1,35,000. And already dividend is declared and it was transferred to the P&L account, should be subtracted. Out of that, 1 lakh is declared and paid. So paid dividends 1 lakh. So out of that, A's share being 45,000 should be subtracted. Now leftover net profit being 90,000. So calculate the amount at which the investment in B Limited should be shown in the consolidated balance sheet of A Limited as on this date. So as on the date of acquisition, the investment value being 15 lakhs. As on the date of 31st March 2024, the value being 15 lakhs 90,000. The value being 15 lakhs 90,000 rupees. This amount not realized, it will be included along with the investment value itself year on year. Clear? Hope now you will be able to understand these calculations. So I have given the format here. Under equity method, investment at cost initially, you have to subtract net worth from that, the ultimate value being either goodwill or capital source. Step number 1. Year on year, from the carrying amount, which is nothing but the book value of the investment, add invested share in profit. Okay. Subtract the distribution of dividend in case any distributed dividend is received. Okay, so this is added, this is subtracted, ultimate value will be the carrying amount subsequently. As you now add the profit, similarly in case of loss, that should be subtracted. So in the illustration what we have now referred has the profit, so added. And dividend is there, which is distributed, and subtract, it is already included in your cash account. From the investment, it is transferred to the cash account and P&L account, no need to include this. Right. Now, investors' proportionate interest from changes in associates equity. Okay. Changes in associates equity. If there is any change happens because of profit and loss, that should also be included because of some other reason. Okay, it's not profit, some other reasons. The investors, the associate company's equity gets affected. Okay, probably there may be revaluation profits, assets, revaluation loss, some other reasons. That should also be adjusted to find out the closing value. Now, shall I move on to the next one? Come on, text me. So as I already told you, 3 chapters are most important. Try to put more working and efforts for those 3 chapters. Internal reconstruction, amalgamation and CFS. On CFS, these 3 chapters are over. These chapters are nothing but the same replication. So very simple. A matter of 1 hour is more than enough to finish up this. Thereafter, just go for revision only. There will not be any load and scoring area also. Okay. There, of course, scoring area, but requires more efforts. Take one more another 15 days or 20 days to finish up these 3 chapters intensively. Clear? So past year's question papers also, the collections of questions also given. Try to work out those illustrations. Right. Now let's move on to the next one. Come on, try this. A Limited acquired 10% stake of B Limited on 1st April. April 1st, they acquired 10%. If they acquire only 10%, there is no holding status, no associates, only investment. Further 15% on October 1, automatically by this time, associate status now emerges because 10 plus 15, 25. So you have to calculate this AS number 23 format only when there is an associate status. If there is no associate status, simply investment only. Simply investment only. So this time it is only investment. AS number 23 is not applicable. In this case, automatically this become significant influence and the AS number 23 will be applicable. Equity method is applicable. Is that clear? Sir, what happens if further he sells 20%, thereafter only 5%, sir? Thereafter again AS 23 is eliminated. You no need to follow AS number 23. You are going to follow the AS number 23 only when you have the significant influences. If you don't have the significant influence not required, suddenly non-significant influence to significant influence status is arrived. Then you start follow. Later, significant influence to non-significant status moved out. The significant status is moved out and now becomes non-significant. That case also you no need to follow AS number 23. Right. So here, cost of investment for 10% being 1 lakh, another 15 lakhs being 1,55,000. So what is the investment value? Cost of acquisition 1 lakh plus 155, 2,55,000. 1 plus 1.55 minus net worth. Net assets on April 1, 2000, April 1 means at this time, net worth being this one. Thereafter, in October, another purchases happen. By the time the net worth is this much. So, for the 10%, 8.5 lakhs, you know, for the 10% will be your holding, 85,000. Another 15% we purchase by the time the net worth increases to 10 lakhs. So, from April 1 to October 1, there is a sudden change in the net worth by 1.5 lakhs. Probably huge profit they could have earned. Because of the profit, 8.5 lakhs becomes 10 lakhs. The 10 lakhs is the net worth when you have 15%. So from the 10 lakhs, you have to calculate 15%. This will be 1.5 lakhs. 1.5 lakhs. Hope you will be now able to understand. So 1 lakh paid for 85,000. 1,55,000 is paid for 1,50,000. So ultimately 2 lakhs 35,000. You paid 20,000 rupees excess. Excess payment will be named as goodwill. Clear? Also calculate the amount of goodwill or capital so arising on significant influence if the cost of investment for 10% being 80,000, 15% being 135. Okay, what happens here? So your investment rather than this one, 80 and 135, then overall value being 2 lakhs 15,000 and of course net worth being 2 lakhs 35,000. So that 2 lakhs 35,000 is the net worth, but the payment is only 2 lakhs 15,000. You have paid lesser. Lesser by how much? 20,000 rupees. Then this will be called capital reserve. Is that clear? Very simple. Now, shall I move on to the next one? Circumstances under which equity method is followed. When are we going to follow the equity method? Equity method is followed by the enterprises having significant influence. If you have significant influence, you have to follow. Though you have significant influence, yet you no need to follow AS number 23. What are the circumstances? Control that you have is only a temporary purpose. So you invested 30%, you have significant influences. But anyhow, the investment 30% is for only temporary. Within 3 or 4 months later, I'm in need of money. So by the time I will finish up selling 20%, thereafter significant influences reduces to 10%. This holding anywhere between 20 to 50 for a temporary period, probably less than 12 months. So then AS number 23 is not applicable. Okay. Disposed in near future, less than 12 months. Second, okay. Though you have more than 20 percentage, but there is severe long-term restrictions. What's that? Sir, I don't want to control that company, sir. I hold 30 percentage. I want to sell the shares, but there is a significant restriction. I cannot sell. As per some legal barrier, I cannot sell immediately now. I have to wait for 2 or 3 more years. I don't have the intention to run that, but I cannot sell that. So if you are being institutional buyer of any company shares, so you just go and see the IPO, initial public offer. The offer may be used for procuring the shares, means a share amount collected by issuing the share from the retailers, foreign institutional investors, direct institutional investors, as well as high net worth individual institutions. These institutional investors and high net worth individuals know they apply, and with a guarantee they will not sell for at least 2 or 3 years. So I purchased 30 percentage, but I have the restrictions to transfer. That's the problem. I don't want to take the control over that company. So operates under severe long-term restriction, which significantly impair its ability to transfer the funds. So impair, I have the trouble to transfer the fund to the investor. I cannot transfer. In the above cases, in both the cases, investment is treated as merely investment, not comes under AS number 23. You don't need to follow AS. If AS 23 is not required to be followed, then automatically AS number 13 will come. So being holding company, holding in another company anywhere between 20 to 50, having significant influence, AS number 23 is applicable while preparing CFS. If CFS is not required, that will be considered as investment. How can we value such investment? AS number 13 says how to calculate all these things. We have to study that one also later on. So whatever the investment, so what happens? What is journal entry for investing in company X? Say an amount of rupees 1 lakh. Simple, right? Investment account debit to bank 1 lakh, 1 lakh. What happens? This appears in the balance sheet asset side. Very simple. But what happens here, you have to follow the provisions given in AS number 13 series. That's all. What you already learned about investment, fine tune under AS number 13 as a rules. That's all. Clear? So whatever the things we do for the uniformity, AS will be there. Clear? Let's move on to the next one. An investor should discontinue the use of equity method. So already I followed AS number 23, equity method. Do I want to discontinue? I think I want to discontinue. Will it be possible? Yes, of course possible. When ceases to have significant influence, 20 to 50 percentage, I hold around 30 percentage. Now I sold to 20 percentage. Hereafter I have only 10 percentage. The moment you sell all the shares, now you lose the significant influences. Thereafter you don't need to follow AS number 23. Is that okay? And but retains whether whole or in part. A part of amount or some amount you may hold. Second, the use of equity method is no longer appropriate because of severe long-term restrictions to sell this share. Though you have significant control, but you want to move out of that, but you cannot move out of because of the some constraint you have to sell the shares. Then also you can follow the simple AS number 13 rather than AS number 23. Is that okay? Now what happens? 100 shares. Company A, H holds 30 shares. Okay, 30 shares. Then automatically what happens? AS number 23 is followed. Now, A sold out of 30, 15 shares sold. Now we have only 15 shares. The number of shares in A being 100. Now the holding status means associate status is lost. AS number 23 is not applicable. Now, H company holds 30 shares and issues the right shares by A. Right shares subscribed by totally different team, where now number of shares being 200. So A has not subscribed any further share. And sorry, H has not subscribed any further share. A has issued another 100 shares in the market. Now the total number of shares in A being 200, but H still holds only 30 shares. So automatically what happens now? The holding status is only 15%, not required to follow AS number 23. Okay, so here retains whether in whole or in part. This is what about in part. This is what about in whole. Here I retain the whole number of shares, but because of the additional share issued by the associate company, I now lose the significant influence that there. So if I lose a significant influence, I no need to follow what? AS number 23 not required. Clear? Now let's move on to the next one. Now, application of equity method. How can I adapt the equity method, sir? Already we solved the illustration using the equity method, so it will not be complications for you. Number one, how do we calculate equity method? Similar to AS number 21. Cost of acquisition minus net worth. The cost of control, what we used for CFS calculation, the same will be applicable here. Second, investment in associate is recorded as per the equity method. Okay. And third, usually investment in associate is recorded at cost. Difference will be either named as goodwill or capital reserve. In case of step acquisition means initially you purchased 4%, thereafter another 5%, thereafter another 10%. The moment the installment purchase crosses 20%, automatically you become the whole, means the other company, investing company becomes your associate. Is that okay? So you have to calculate only by the time, acquisition by lot. Eliminate unrealized profit. If there is any unrealized profit, like unrealized profit on unsold stock or assets transferred by adding some profit by holding to subsidiary, subsidiary to holding, here holding to associate and associate to holding. In those cases, that unrealized profit should be eliminated. And any loss on intercompany transaction are not eliminated. Only profit is removed, but loss you cannot remove it. Okay. As per the contingency concept, unrealized profit is removed, unrealized loss cannot be removed. There is unrealized loss. By eliminating, your profit will be increasing. Don't show additional profit unless it is confirmed. Okay. So to the extent that such a loss is not recoverable, otherwise such losses are written off in the CFS fully later on. Right. Seventh one. Discontinue to recognize. When you are able to discontinue to recognize this, means showing the subsequent additions or subtractions. Year on year, there's a profit. Do I want to show it subsequently? No need to. Once the carrying amount becomes 0 or negative. Okay. Here, the carrying amount increases from 7 lakhs, carrying amount increases from 15 lakhs to 15 lakhs 90,000 rupees. Reverse may also be happening, right? In case of loss, you have to subtract. If you are subtracting year on year, the cost of acquisition sometimes becomes 0 or negative. What happens, the loss being 25 lakhs. If I subtract this, then the value being 10 lakhs negative. What can we do, sir? Can I show the associates value under equity method as 10 lakhs negative? No. Once it becomes 0 or lesser, stop with 0 only. Stop with 0 itself. Should not show negative value. Is that clear? Thereafter profit comes. What can we do, sir? Until this negative value written off, you continue to show the value as 0 only. The moment the profit makes more than this 10 lakhs loss, to that extent the excess will be shown as your carrying value. Is that clear? Let's try this illustration to make you understand the concept. Thereafter, we'll finish up the rest of the theory. A Limited acquired 40% shares in B Limited on April 1, 2021 for rupees 10 lakhs. On the date, B Limited had 1 lakh equity shares of rupees 10 each fully paid and accumulated profit being 2 lakhs. So first we start with 1st April 2021. Cost of acquisition of the investment being 10 lakhs minus net worth. Okay, equity being 10 lakhs, accumulated profit being 2 lakhs. On that, the holding being 40 percentage. How much is that? 4 lakhs 80,000. Am I right? 4 lakhs 80,000 rupees. 5 lakhs 20,000 will be goodwill. 5 lakhs 20,000 will be goodwill. Now, in your CFS, shares in B, and goodwill. Goodwill being 5 lakhs 20, the value of the share being 4 lakhs 80. You have to show this 10 lakhs into splitted manner. Goodwill separately as well as share value separately. This is on acquisition. During the year 21-22, B Limited suffered a loss 10 lakhs. So 21-22, there's a loss. Now in your CFS, what about the shares value? Share of B, already we know it is 4 lakhs 80,000 rupees. Goodwill being 5 lakhs 20. You have to subtract the loss. Loss being 10 lakhs. Percentage of holding is 40%. 40% will be adjusted here, 4 lakhs. 4 lakhs. Is that okay? Now if I subtract, then what about the value of the asset in consolidated balance sheet? Investment 6 lakhs. Clear? The loss will be now adjusted. Then during 22-23, loss being 12 lakhs 50. Okay. We'll go for 22-23. Loss being 12 lakhs 50, and there is another 10 lakhs, 22 lakhs, 40% on this being in CFS. Share of B 4 lakhs 80. Goodwill 4 lakhs 20,000, 5 lakhs 20,000. Minus loss. How much is the loss? You add these two losses and calculate 10 plus 12.5. The loss, accumulated loss as on this date being 10 plus 12.5 in their balance sheet. The loss may be 22 lakhs. Out of that, 40% will be considered here, 9 lakhs. Then in CFS, the value will be shown at 1 lakh. During 23-24, again a loss of rupees 5 lakhs. 23-24. Okay. (23-24). In your CFS. Now, share in B being 4 lakhs 80, and goodwill being 5 lakhs 20,000 minus loss. Overall loss being 10 plus 12.5 plus 5. In the balance sheet of B, year on year, the loss is accumulated. If you go and refer the balance sheet as on this date, the balance sheet shows 27 lakhs 50,000 being the loss. 27.5. On that 40% will be calculated. How much is that? 11 lakhs. And what is the investment value in CFS? 0. You cannot show in negative. You cannot show in negative. If you get profit in the next year, say 1 lakh profit, or the loss is decreased, okay, 27.5 reduces to 26.5. Again calculate 26.5. Also you get negative. Okay, you'll get negative. Okay, so until it becomes 0, you cannot again subtract. You don't need to subtract. If there is any profit, don't subtract. Okay, now hope now you'll be able to understand the way of posting in the CFS. The way of posting in CFS. Now, what about investment value as per AS number 13 in standalone financial statement? AS number 13, investment. Okay, investment. In investment, you will be showing at what value? Original value 10 lakhs minus the loss 4 lakhs is subtracted, so it is 6 lakhs. You don't have the breakup for goodwill or capital reserve separately here. You understand? And in this case, okay, you can subtract the value. Carrying amount being 5 lakhs. AS number 13, investment. Carrying amount, okay, our book value being 6 lakhs. Now, here the loss being 40% and 12.5 lakhs. How much is that? Five lakhs. Now, the ultimate value being 1 lakh. And what about here? AS number 13, investment. Already your book value being 1 lakh. Now, you have to subtract the loss. For 5 lakhs, 40%. 2 lakhs is subtracted. Anyhow, investment value cannot be negative, so 0. So, in your CFS only, you are segregating the purchase value into goodwill and capital reserve as well as balance for the shares. In investment, how do you calculate? What is the journal entry for investment? Investment to bank. So, investment to bank here in the time at the time of purchase, as per AS number 13 in your financial report, standalone financial report, your investment value being 10 lakhs. You don't do any such a classification. 1 year later, there is a compulsory loss. AS number 13 will study. If there is any loss happen in the business, that loss value will be adjusted in the carrying amount. So here the loss amount 4 lakhs is adjusted. Now the investment is 6 lakhs. In the next year, loss amount is 5 lakhs subtracted from 6 lakhs. The next year, loss amount 2 lakhs is subtracted from 1 lakh. But anyhow, limited liability principle, right? So as per the limited liability principle, what amount you invested, you are liable only to that extent. So you don't need to worry about the further one. So under CFS model, share, goodwill, capital reserve segregated separately and shown separately every year. The accumulated profit will be adjusted. It will have complete set, but ultimate value should not be negative. But in case of investment, the original purchase price year on year you have to adjust for the profits and losses. Clear? So the adjustments of this profits and losses, anyhow, we'll be studying that in detail along with the AS number 13. Yes. Now, while preparing the consolidated financial statement, H company, associated company, H company may follow financial year, associate company may follow calendar year. How can I integrate, sir? To integrate, you can change the informations of A as per the financial year to add here. In case of inventory valuation, we have a number of models like FIFO, LIFO, and all. If H limited follows FIFO and A follows weighted average method, then you can convert this into FIFO and then you can merge. See, eighth point. Follow the same reporting date for financial statements and CFS. While preparing CFS as well as a separate financial statement, you have to follow the same financial year statement. For H as well as A, and then you can merge. Same accounting policies should be followed while preparing the financial statement as well as CFS. When I say the term financial statement, it represents the independent, separate one. And the carrying amount of investment should be reduced for permanent decline only. Permanent decline only. This you will study along with AS number 13. We assume these things are permanent decline. That's why I am subtracting this one. I am subtracting this one. If it is not permanent decline, I will not adjust this. Okay. You no need to worry about this component. In this case, my focus is only CFS. I have just given a single liner for the AS 13 valuation here. Anyhow, we'll study AS number 13 in detail along with accounting standards number 13. So, after finishing, I'll just go for AS number 27. After 27, I'll jump to AS number 13. Right. Let's see. Contingencies. In accordance with AS number 4, investor discloses share of contingencies and contingencies that arise because the investor is severally liable. In those cases, you have to show. Okay, you'll study the contingencies and all AS number 4. Contingency is nothing but any liability because of happening some worst scenario, I have to pay. That's what about liability. It is not liability, may become as a liability because of worst scenario. If I am being the holding company status for some associated company, I am also supposed to liable for this, means I have to incorporate in my books. That's called contingency, showing the contingency. How can I define this is contingency or not? How can I adjust for all these things? No need to worry about that. So you have to interlink with AS number 4. That AS number 4 is the chapter for contingencies only. Why is equity method of accounting is adapted? Okay. So why do I follow equity method? If I invest, what's my intention to investment? For investment, get some return. If I invest in bond, I get interest. If I invest in the share, I'll get dividend and capital appreciation. That's an intention. But in case of this one, 20 to 50 associate, I need to influence the decisions also. So, not only to earn revenue from investment, and I need to participate in decision making process. That's why while invested CFS are prepared, equity method is also followed if there is a significant influences. Understand the logic of following equity method. And now go for the disclosures. Ownership interest. What is the percentage I have? 30%, 25%. And if it is not being the purely significant influences, then that investment will be now classified as long term or short term. I'm going to hold it for a long period or short period. And reporting date is different, then you have to mention that. Policies are different, then you have to update this. And why do you choose equity method if not chosen? So if the reason if equity method of accounting is not followed, you have to tell me. So though you have 30%, still you don't follow equity method, then you have to disclose, because I'm going to hold it only for the temporary purpose. Though I have more than 30%, but I cannot convert my investments into cash because of some restrictions. You have to intimate this reason. And goodwill or capital ratio should be disclosed separately. You understand? So seems to be both are same, like under CFS also the value being same, under AS also value being the same, but under CFS goodwill is shown separately. That's why. What about the main difference between CFS model as well as separate investment model? Okay. Now some relevant explanations are also there. How can I handle in case of proposed dividends, sir? In case of CFS, what we do in case of proposed dividend, I tell you don't bother about that. You skip it. If the post acquisition proposed dividend from the post acquisition profit, you skip it because the post acquisition profit will be addable with the P&L account. Proposed dividend also be addable with the P&L account only. There is no any effect, so you no need to worry about that. Same happens here. So without taking into consideration, you can prepare as usual as per AS number 21. Consideration of potential equity shares for determining whether an investee is an associate or not required. Okay, potential equity shares are not going to be considered. Under EPS, you will study the potential equity share, but here I will just tell you. So, A and B. A holds 500 shares and B's total number of shares being 2000 shares. And A has convertible preference share capital. Convertible preference share capital. Matter of 2 years later or 1 year later. In the next financial year, the preference share will be converted into 400 new equity shares. So currently 500 means 500. Okay, I can make it 300. 300. Okay. If it is being 300, my holding is only 15%. I don't have significant influences. But I have convertible preference shares. The preference share is converted into equity share sometimes later. Because of that, my number of share will being 700. The number of shares in B after issuing this one becomes 2400. So 700 divided by 2400. Come on, what's the percentage now you have? 29%. Currently, we have only 15%. I have the rights to convert my preference shares into equity share. After conversion, my shareholding being more than that. Now tell me, will I be considered as having significant influence in B or not? Currently not. Currently not, because this conversion is called potential equity shares. May be converted into equity shares later. For the determination of the holding, investors should not be taken into account. Means the potential equity share held should not be taken into account. That will not be considered. This part will not be considered. Only the proper equity shares what you hold will be considered for the holding purpose. Is that clear? So with that, AS number 23 is over completely. So AS number 23 one session, AS number 27 one session, AS number 13 I need 2 sessions. That's all. With that, all the predominant AS will be over. Okay.